Inflation came in hotter than expected in the government's latest report, leading to a sell-off in the stock market and increased perception that the Federal Reserve will get even more aggressive with interest rates. In today's video, we're going to look at what's driving the latest inflation numbers, what the outlook is for it actually peaking, and what all this means for mortgage rates and the housing market. Let's get into it. The Bureau of Labor Statistics reported that the Consumer Price Index, or CPI, increased by 8.3% in August compared to the same time last year. This was down from the 8.5% in July and the recent peak of 9.1% in June, making it the second consecutive month of deceleration and continues a trend that suggests consumer inflation has peaked. But has inflation really peaked, or is this just a temporary softening with more pain on the way? Let's take a look at what's driving the headline number and what it means for the outlook going forward. One of the primary factors behind the deceleration in August was a big drop in gasoline prices. The index fell by 10.6% on a monthly basis, and looking at the annual percentage increase, it reached 25.6%, the lowest level since March 2021. Gasoline prices have come down as the price of crude oil has trended steadily lower the last few months. And oil prices are down in large part due to slowing global economic growth. The U.S. economy, as of the recording of this video, is in a technical recession, meaning it has at least 2 consecutive quarters of negative growth. If you're wondering how we could be in a technical recession while so many people insist that we are not in a recession, check out my recent video I released on my other channel where I track the overall economy. I'll leave a link to it in the description down below. Economies throughout the world aren't faring much better than the U.S. Europe is widely expected to enter a recession as they face a severe energy shortage in the wake of geopolitical tensions with Russia because of the war in Ukraine. China's economy is widely viewed as slowing, if not declining, due to their zero COVID policy as well as extreme heat and drought that has dried up one of their major rivers and subsequent hydropower for electricity. Both factors are hurting factory output. If there are no more major shocks to the supply of oil, gasoline prices for the most part are experiencing headwinds to growth, given the recessionary environment major economies find themselves facing. So the outlook on gasoline prices from an inflation perspective is pretty good. Absent some other black swan event, slowing or declining economic growth is likely to keep gasoline prices in check. The next big component of the CPI to look at is shelter, which is flashing some big warning signs. The shelter CPI index accelerated to a 6.3% annual rate in August, up from 5.7% the month prior. This was the highest level of shelter inflation since April 1986. Skyrocketing rents throughout the country have been the big driver of that, and behind that has been the run-up in home prices over the last 2 years. As property values have risen, so have property taxes, and landlords have little choice but to pass that on to tenants as they renew their leases. The shelter index makes up roughly 1/3 of the weighting in the CPI, so what happens in this category is very important to watch. The latest numbers, where we're seeing shelter inflation accelerating, are quite concerning, but looking over the next 6 to 12 months, I think the outlook is better than some might think. We've already seen a turn in the U.S. housing market overall, and prices are much likely to head lower than higher in the next 6 to 12 months. If you're new to this channel and want to know why this is the case, check out my latest video on the U.S. housing situation. I'll leave a link to it in the description down below as well. The decline in home prices will put downward pressure on rent growth for the simple fact that if renting a home is more expensive than owning a home, landlords will not have as much pricing power as they did when home prices were on the rise. Now let's take a look at food prices, which in my opinion are the most troubling as future drivers of food prices are heading in the wrong direction. The food price index annual growth accelerated as well, increasing from 10.9% in July to 11.4% in August, hitting its highest level since April of 1979. Unlike the near-term outlook for gasoline and shelter, the outlook for food prices is for them to only go higher for a wide variety of factors. The war in Ukraine continues to threaten present and future wheat, corn, and other exports as shipments of the past harvest and planting for the next harvest have been limited. Both Russia and Ukraine are major exporters of grains and cooking oil for much of the world, and extreme heat and drought have also had an impact on the agriculture industry throughout the world. Here in the U.S., it is affecting crop quality and quantity, and the livestock industry has suffered as well. If animals are not dying outright from the extreme heat, ranchers have had to cull their herds prematurely as their ability to keep them alive diminishes. And in the background of all this, we are still in the midst of a global fertilizer shortage, which will have an impact on yields that the world depends on. When it comes to food prices, it's important to remember that the food on the shelves of grocery stores right now, in general, are from the last year's harvest. 2022 has definitely been worse for the industry than 2021 was, so there will likely be even greater upward pressure on food prices in 2023. So these are the three big components of inflation that I'm keeping my eye on, as they are the basics for what we need to exist in a modern society. We need shelter to live in, we need gasoline to get to work, and we need food just to stay alive. The price pressure on gasoline and shelter could lessen over the next 6 to 12 months, but food prices are likely to head higher. So while we may see consumer inflation peak, it's likely to remain elevated going forward and running above the Federal Reserve's 2% target for some time. The situation is serious enough that the Federal Reserve is going to maintain their tightening of monetary policy and are likely to raise their Fed funds rate by 50 or 75 basis points at their meeting next week. This will maintain upward pressure on mortgage rates and continue to hurt housing affordability for potential buyers. In my last housing market scenario update, I estimated that home prices could pull back by 10 to 15% by the end of the year, based on the Fed's likely policy paths. Check out that video if you want to find out more about those scenarios. And after the Fed meeting that wraps up September 21st, I'll be releasing a new scenario update video that takes into account all the data over the last month. I should have that released by the end of September. If you want to see that video when it comes out, make sure you hit that subscribe button down below, as well as the notification bell, so you know right away when that and my other videos come out. And if you've made it all the way to the end of this video, please leave me a thumbs up to help it get ahead in that YouTube algorithm. Thanks for stopping by. I'll see you in the next video.